I know the problem that you had assigned to you last Friday was a very difficult one. So what I'm going to do here is to show you uh, what it was all about. What I was attempting to do by that assignment was to have you use what you've learned in topic 7 about cost of goods sold and then apply it to an income statement. We have not talked about all of this specifically, but I wanted to see if you could take that next step. So, because it confused most, if not all of you, we'll kind of backtrack just a bit here, and I'll explain it to you, and then let you try another one very similar to it. So let's take a look at the screen. This is the widget manufacturing company. Ideally, if you did everything correct, the income statement would look similar to the one on the left. And I want to walk you through that because it includes things about cost of goods sold, and it includes something new called indirect expenses that we will explain to you now because it obviously was confusing. So let's begin at the top. Look at the directions. Here, this is a manufacturing company, the widget manufacturing company for the month of April, and you need to use the formula that I give you right here uh, to determine the cost of goods sold. And for a manufacturing company, this is the formula. You take beginning finished goods inventory, add to it the cost of goods manufactured because you are manufacturing something, and to find the goods manufactured, you include direct labor, direct materials, and direct overhead of heat and electricity in this case. Then you subtract the ending inventory. That gives you the cost of goods sold. Now, uh, the direct labor and direct materials and direct overhead deal with things that are obviously mean what the titles imply. They are directly concerned with manufacturing. So if you have direct labor and materials and in particularly overhead, you probably someplace have indirect, and that's the new part that I threw at you. So you see them all listed there underneath the directions. And let's see if we can plug them in. The total sales for April, $50,000. You see over here in the income statement, total sales of 50,000. And this, as we said before, doesn't include the entire picture. So we need to subtract from it the cost of goods sold. So we find the cost of goods sold by using this formula that we show on the right. We plug in those pieces. And we begin with beginning finished goods inventory. And you see that I have listed it here, beginning finished goods inventory of 6,000. That came from the directions over here. And then we add to it, there's a plus up here in the formula, we add to it the cost of goods manufactured, which includes these three things: direct labor, direct materials, and direct overhead. And they are listed under the directions here. Direct salaries expense. Well, that would be labor, wouldn't it? Direct salaries expense for the workers in the factory, 20,000. So we plug that in, 20,000. Direct materials, 3,000. And I give you that over here. Direct materials used in the factory, 3,000. And then the direct overhead of 2,000. Direct overhead expense in the factory, heat and electricity would be 2,000, and we have that plugged in. So when you add up those three, you end up with 25,000. So if you go back to the formula, beginning finished goods inventory, 6,000, plus the cost of goods manufactured, direct labor, direct materials, and direct overhead. That's these three things. We're adding these three things, coming up with 25,000. Add the 25,000 to the 6,000, but we're not finished with the formula because the last part says minus the ending finished goods inventory, and that gives you COGS, or cost of goods sold. So the ending finished goods inventory of 4,000 is found again on the or under the directions, 4,000, and we subtract that. That's why there's a little parentheses there. That's how Excel shows that. So if you add the beginning finished goods inventory to the cost of goods manufactured of 25,000, excuse me, and you subtract the finished goods inventory, you will come up with 27,000. That's the cost of goods sold. And this part of the income statement is directly from this formula. So you need to know those items, and they're all listed there. So if you then find cost of goods sold using that formula and subtract that cost of goods sold, 27,000, from the 50,000, you will get gross profit, 23,000. So that's how gross profit is found. Way back at the beginning of the course, you did income statements and did not have any of this. It was very simple. But this is in the real world how it would look for a manufacturing company. Then the new part that I did not explain to you before, but this is listed here, as you can see, on the income statement, because we still have other expenses. In this case, for the office, we have indirect salary expense of 15,000, and that's mentioned over here. Indirect salaries expense 15,000. Indirect overhead expense, in other words, heat and electricity that are in the office, used in the office, $1,000, and that's plugged in. Telephone expense, which would be in the office, as it says there, 500, and that would be listed here under the office expenses. Advertising expense would not be a direct expense of manufacturing. That's not part of cost of goods sold. Obviously, it would be listed here under expenses for the office of 6,000. And again, adding up all those, you will come up with total indirect expenses, or total expenses for the office, and probably this ought to be labeled as such. This should say total expenses for the office. And that, after adding all those up, it gets 22,500, and you subtract those office expenses from the gross profit, and you get the net profit of $500. So that's how this works. And I realize you did not have anything explaining indirect expenses beforehand, but this is how it works. I wanted to see if you could figure this out, and I know it was a bit more challenging for you than we expected. So this is how this works. And now I'm going to give you a very similar problem and ask you to do what we just did. So if you need to review this do so. You can back it up and stop it and look at it again if you need to. But I'm going to give you a similar problem and ask you, based on all of these typical kinds of expenses, both direct and indirect, and all of the other inventory amounts, I'm going to ask you to plug in those things into an income statement and end up finding not only excuse me, not only the gross profit, but in the end the net profit, or we often call it net income. It means exactly the same thing. Okay, so go back to your course page now and take a look at that problem.